So why is a rate cut even on the table? The answer lies in the Fed's unspoken mandate, maintaining global financial markets stability. Since Alan Greenspan's era, the Fed has prioritized propping up markets over strict adherence to its dual mandate of full employment and price stability. A rate cut, likely 25 basis points, though a 50 basis point cut would have a stronger effect, would delay the inevitable correction in stock prices, particularly in the overhyped AI and tech sectors. However, even a significant cut might not be enough to sustain the bubble indefinitely. If the Fed cuts rates aggressively, it risks sending the wrong signal to markets, potentially exacerbating inflation and undermining confidence in government debt. Real interest rates are already negative, and further cuts would reduce the incentive to hold bonds, which are essentially future fiat currency. Long-term yields are rising, creating balance sheet holes for financial institutions, a problem that can be masked only as long as liquidity remains abundant. However, speculative and inefficient AI and stocks investments are draining liquidity, setting the stage for a potential crisis with even margin debt on stocks now at new all-time highs. The Fed faces a stark choice: prop up markets at the cost of economic stability or allow a correction that could trigger a stampede out of stocks, reminiscent of 1929 but potentially worse. The initial impact will hit overvalued tech and AI stocks, followed by banks, financial firms, and real estate. Credit markets, already showing signs of stress with rising delinquencies in commercial real estate, consumer lending, and beyond, could seize up if debt investors panic. The bond market, 10 times larger than the stock market, could amplify the fallout in a high inflation environment.